Hi everyone, this is Mike Bond with Hard Money Mike. Today we're going to talk about one of the biggest terms used in real estate investing, and that's ARV, after repair value. How do we calculate it? What is it? And a simple tool we're going to give you free just to analyze each deal. So let's dive right in. What is ARV? Why is it so important? Because real estate investing, or at least the real estate investing we're talking about, is all value add properties. That means you're going to take a property, you're going to add some value by either splitting it up, maybe doing some repairs to it, whatever it may be. Where you start and where you end, the values are going to be greater at the end. So that's going to be the after repair value, the value that it could sell for in an open market, or not only sell for, but maybe even just appraise for if you're keeping the property as a rental. So in this industry, when we're talking about value add properties, we're always talking about what's going to be worth, what is our profit potential in a property, and that all comes down to after repair value. So after repair value is really just a guess. It's an estimate of what the value is going to be, because there's a few factors you have to take in. What is the quality of work? What are you going to do with that project? So you have to understand what you're doing to the property, what you're putting into it, and what that will return for an investment. Because after repair value is based a lot on what you're going to do to the property. You adding bedrooms or you adding granite, whatever it may be, it determines what it's worth. Let's go through a quick example of what we look at for after repair value and other hard money lenders. So remember, after repair value is more of an art than a science, just because we don't know what it's going to actually look like, what the quality of work and everything that's going to be put into it at the end, but we can only guesstimate, estimate, and that's why after repair value is just an estimate. To get that estimate, we're going to take the property you have, the property that you're going to purchase, and we're going to compare it to like properties after you're done with the work. So we're going to look at a few factors. We're going to look at properties that are just like your property but finished. We're going to look at properties in the same area, so we want to make sure they're in the same subdivision or within a half a mile to a mile at the most. You want to make sure they're the same size. What is the square footage? You're not going to compare a 1,200 square foot place to a 2,000 square foot place. When you're looking at these values, when you're putting them together, looking at same properties, you just got to put yourself in that picture, in that moment where if you were buying a house, would you pay the same for a 1,200 square foot house as a 2,000 square foot house? And the answer is typically no, if they're in the same area with like finishes. So we have same area, same size, and then we're going to look at same condition. This goes back to what are you going to do to the property? What's it going to look like when it's done? Are you going to finish the basement? Are you going to move a wall? What does it look like compared to the properties that have already sold in your market? So that goes back to what are we comping it out? We're looking at solds within the last 6 months, or even better, the last 3 months in that area. If you can find properties that have sold, not listed, because if you find a property that's listed or under contract, you don't really know what it's sold for. So we're looking at properties that are in the same area, the same size, the same condition, that have all sold within the last, hopefully 3 months, but really 6 months at the most. So once again, after repair value is what it's going to be worth at the end. You're also going to have to look at concessions. Are the sales that are happening in your area paying concession, which means the seller is helping the buyer buy the property with some of the money from the sale. You can find in some areas where sellers will contribute anywhere from 3 to 6% of the sale price to help the buyer pay for closing costs, especially if it's an FHA or VA market. So you have to watch out for those things because you have to net those out. For example, if a property says it's sold for $200,000, but it has a 5% seller concession, that means they've received 5% less. Instead of $200,000, they only received $190,000, because that's 5% of $200,000 is $10,000. They, as a seller, did not really receive $200,000, they received $190,000. And as an investor, that's important because you're thinking about your bottom line. What is going into your pocket from this project? So you want to make sure when you are looking at values and putting all your numbers together that you do net numbers, which is net of seller concessions. So as mentioned, ARV is really an approximate value based on what's going to happen. So that's the last thing we look at. What are the market conditions? Last year in 2022, we saw a market decline after May of last year. We have to take those into account. So if I'm comping out a property like last June or July, and I know the market conditions may or are going to get worse, I'm going to factor that in. I may cut 5 to 10% off of that number to make sure when I sell it, I'm going to make some money. So let's recap real quick on ARV. Remember, ARV after repair value is just an estimate because we don't know exactly what your property is going to look like or the market's going to look like or other properties for sale. Because if you have or competing against multiple properties in your area for sale, it may come down. If you don't, maybe it'll go up. It's based on you doing the research on properties that are in the same area, the same size, in the same condition, depending on market conditions. And we're going to go through an example in a coming video where we're going to actually break it down. We're going to look at areas and see why some areas are like and some are not. Even properties that are just split up by a road. So maybe there's a road that separates one market that's a little bit higher compared to the one you're buying in, or even vice versa, where your property is worth more than some of the comps just across the road. So we're going to go through that in another video coming up, just breaking it down. I just wanted you to understand what ARV is and what you're looking for, and really estimate or trying to find out what it could sell for or what an appraiser will appraise it for when you go to refi. And here's another reason why ARV is so important, because lenders use it. Lenders like us use it when we're trying to do a loan for a fix and flip or a fix and rental. We're going to use a percentage of the ARV for your maximum loan amount. So if we look at your property and we could see that properties just like what you have and what you're going to do to it are worth, let's say, $200,000. And we're going to lend up to 75% of the ARV. That's the max we can lend. That means we as a lender, you as a borrower, understand that the maximum amount of leverage loan that you'll get is 75% of the $200,000 or $150,000. So this is just a quick way for you when you're looking at properties too, and that's why we're going to offer you this quick deal analyzer where you can put some of these things in and just quickly do your numbers. What is the maximum loan I could get on this property? It's going to be based on the after repair value. We as lenders are going to look at like properties and like areas that are like size, and then we're going to lend a percentage of that, and we're going to lend you somewhere up to 75% in this market. And why only 75%? We talked about in another video. That other 25% is made up of your profits, of the selling costs, and some of those items that are not real out-of-pocket costs until you sell the property. So ARV is important when you're dealing in value-add real estate. That means you're buying properties under market and you're going to do something to create value and create wealth by doing it. It's also important when you're getting your loans because lenders are going to base your lendable amount on your ARV. So remember, when you're comping out, be truthful with yourself, look at like properties and like areas that are in the same market conditions. You'll be fine calculating your ARV and estimating your profits and the amount that you could borrow or potentially borrow from a lender. Like I mentioned before, we're going to actually go through an example coming up here in the next week or two of running through and looking, getting the computer out, looking how we comp it out on either Zillow or PropStream or one of those items, just to see within a certain amount where the ARV is. That free tool is below. Just check it out. It's a great tool for you to just put some numbers in and see what the lendable amount is on that property based on ARV. So if you're looking to make more money in real estate, check us out on the next video.